Ladies and gentlemen, as a capitalist, may I start with gratitude. May I thank all of the Patreon supporters. I'm enjoying reaching out to those in the John Galt category. And I look forward to more of you joining us. We're doing mentoring sessions and curiosity sessions. And your great support makes this programming possible. And for everyone else, we hope you enjoy the first 30 minutes. And then I'm afraid we will then go beyond the firewall. Today we have Sir Tom. The Brits are always sirs, and this is definitely a sir. This is my ex. How has I got too many exes? My ex-investment partner, the genius with numbers, the rascal, the terrier, the person who has the audacity to give me the finger and say, as a capitalist, you're talking rubbish. I speak, of course, of the global macro hedge fund manager out of London, Tom Roderick. And we're going to have a catch up. We've been speaking over the last 18 months. We've had a series of these conversations which have coincided with the very rapid monetary tightening that we've seen globally. Did it come too late? Tom, great to see you again.
Oh, thank you for having me, Hugh. It's been a while, actually. I think it was before Christmas we spoke last on here. So it's good to catch up again, and good to see your new business endeavours are going well.
Yeah, it's such a pity you won't be able to join us at the Asset Capitalist Retreat, folks. We kick off on Monday, the 21st of August, but we have wonderful guests arriving over the weekend for a glorious week in the sunshine of fun frolics and, I hope, intellectual kind of curiosity. Sadly, Tom, I think, is going to be I don't know. What are you doing? You're on holiday somewhere.
Yeah, I'm away. It's not entirely sure where yet. Southern Italy, I think.
Southern. It should be St. Bart's. Come to change your plans. Anyway, we were talking off camera, and so Tom, management is all about hedge fund management is about establishing narrative. Narrative is just another word for prejudice. Tom is full of prejudice. He was telling me that his top three positions would be the anticipation and the speculation, profitable speculation from further weakness in China. And that would be represented by a short, the red cabbage. He'd be long dollars and short the CNH, the renminbi. He's also a fellow who believes that I was reading some nonsense in the Financial Times today from institutional investors in the British gilts market who say, "Oh, it's too hot." Tom says, "No, it's not. That's what we get paid to do. We get paid to touch the hot plates on the oven." So Tom believes that we could see a normalization and that the UK inflation is an outlier set to see some mean reversion to the global norm. And then to contradict himself somewhat, I believe, but whatever, he's a payer. He believes that the Japanese yen rates at the 10-year are going higher. Now, Tom, I've been trying to steer my beloved tribe who are active in speculating and trying to protect their wealth in risk assets. And I've been trying to kind of make them think along the lines that we do in hedge funds. The caricature might be the permanent portfolio, the quadratic expression of risk, where we divide it into four sections, which roughly may be equities, risk-free fixed income. Risk-free, of course, always people bride at that suggestion. Real assets or alternative assets, and of course, finally cash, but cash being something which could capture your renminbi short position. So I wonder, maybe could you kind of, where would the folks know where I am positioned, if you will, going around that global macro compass? Could you maybe talk about how you would be setting up these prejudices within a kind of structure which is designed for you to die another day, a structure which is designed to limit the amount of daily intervention? We wish to minimize the number of decisions. And hence one could say it's just fancy talk for diversification. I think it's more than that, but what do you say?
Well, I'm not sure. I don't really generally tend to think in that kind of quadrant framework. And I think often you have, different countries in the world in different places in that quadrant. And so, to take China to start with, I think China is in a very, very different place to the US right now. You've got China's close to deflation. Their stock market has been a bit of a disaster over the last 6 months, certainly massively underperformed the rest of the world. They're seeing currency depreciation. They're seeing rates coming significantly lower, and just generally a very, very underwhelming set of data. And they're still suffering from both their long-term property bubble and the pain that was caused to their economy during COVID. Whereas you look at the US, you've got inflation very high, although admittedly falling. You've got a massive stock market rally led by the NASDAQ. You've got GDP sort of, still going up, but people are getting a bit worried. And so I think there are very, very different points. Like where you put those two countries on a quadrant, I'm not really too sure. But I think, you take each country as it is and you try and find asymmetric trade expressions wherever you can. And,
but Tom, this is the quadratic formulation is not meant. It's designed at the macro level. It's risk asset categorization, and so to my mind, it seems simple that for instance, you could have. For me, I would have some nowhere greater than between 15 and 20%, but I would be allocated to NASDAQ. It's surging, and this is an opportunity to ride on the coattails. I wouldn't have 100% of my portfolio. But in another quadrant, in another global macro corridor, I could have a very large long dollar, short CNH position. They would be mutually consistent, and they would be captured by that framework.
So you're talking about having a permanent representation with different aspects, or are you talking about pivoting across 4 different categories?
Drop the permanent is simply a brand. It's simply it's misleading. I'm talking essentially about a framework devised by Ray Dalio in order to organize his risk taking consistently, diversified, such that he's in control of his destiny. But it draws out, like, here we are, we began with your prejudice, and we have to find, again, I keep trying to encourage people to find the framework to hold it all together rather than just betting it all on the house.
Yeah, well, I guess, what my risk taking does all sort of come from a common narrative. Well, at least a couple of common narratives, and I guess those common narratives are, firstly, that inflation is going to be more persistent than everyone expects. And that sort of guides me to be more short fixed income, to expect yields on bonds to continue to go up in general, and also to be kind of worried about equities, because if inflation is going to be higher, demand is going to be stickier than people expect, then you could see further rate hikes. And I know that's not the camp that you're in, but that's the camp that I'm in. And on the other side of it, I think there are opportunities in certain places, like you mentioned in the UK, where rate expectations for the middle of next year went up to 6.5%. And of course, the UK is a market where residential mortgages are on a very, very short-term rollover compared to the rest of the world. Between 2 and 5 years. Let's say the average is 2.5 years, and so you have a very quick pass-through of rates. And there I see opportunities receiving. Partially,
hold on. You don't have a quick pass through of rates
you
for
do have
two
a pass-through,
years.
quick pass-through. 2 years is quick.
Really, for two. No, well, hold on. But for 2 years, the Bank of England can go from 0 to 4. You won't if you've taken a mortgage out in 2021, fixed for 2 years, your monthly outlay doesn't change, and so you are protected. Like the problem I perceive with the UK is that it comes with a 2 year lag. Like there's been nothing for 2 years, and now it's bang, now it hits
Well,
you.
but look at the US. The US, generally people take 30-year fixed rate mortgages. In the UK, the average is about 2.5. And so the pass-through.
Oh, they're fundamentally different. Yeah, the risk in the US has been pretty much transferred to the capital markets, and they accept that, and there's a return and there's a loss depending on your skill set. The household sector is protected. The household sector was only vulnerable 20 years ago when there were teaser rates, and you could sit there for 2 years and pretend at the wrong rate. And when it came back to where it should have been higher, then we suffered the stress. But my point to you is that monetary policy in the United Kingdom was made, if you will, less effective by the presence of the abundance of 2 year fixed rates, which immunize the household sector from the rate hikes.
Well, that's still pretty low compared to the rest of the world. But to come back to the US a sec, I think one thing that people forget about the US mortgage market is, it's on you fix for 30 years. If rates go down, you can remortgage and reset your mortgage lower. There's no reset on the way up, and so it's a ratchet. You go, your rate as you've seen a rally in bond markets and rates go lower over time. You've gone bam, 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 and on the way up, you're locked in for 30 years. And so the vast majority of US mortgages do not see the impact of rate hikes. So there's pass through of rates one way, and there isn't pass through the other way for 30 years. Whereas in the UK, if you have kept rates high for a year, you're likely to see 40% of households having taken out new mortgages at higher rates. And so that's what I mean, that the pass-through of mortgage rates is much higher than elsewhere. Like there are some countries, I think it's Australia, where there's a lot of kind of floating rate mortgages, but in most of the world, like the kind of the pass-through and the reset term is similar to the UK, or even longer.
No, I mean we agree. But my point is that I'm no fan of the Bank of England, but the hiking cycle for the first 18 months to 24 months was largely negated by the popularity of the fixed rates. Now, the danger now is clear and evident. The hiking comes through with a 2 year lag, but boy, when it comes through, it explodes onto the UK household sector. So again, I agree with you.
But it drips through. There's no cliff, right? It drips through over time. So we're already,
it's pretty
a lot of people have already had to reset.
The quarterly increase, the quarterly roll on the thing is large. It's about, I think, 24% of those mortgages are subject to repricing every quarter.
Yeah, so every quarter you get a new set of people who experience that pain of higher rates, and so there's like a gradual effect with a lag from where the Bank of England sets policy, and this.
I think the attraction of the receiving of rates just now in the UK is made clear by, the silly comments from silly institutional investors like, oh, UK is just, just something not right about it. It's like, guys, you got to understand the damn mortgage market, right? Monetary policy is now going to be very, very effective. Inflation is, we got the print today. Inflation is now coming in. Monetary policy is going to be very effective. You want to be receiving. That's principally, I imagine.
Like I think the thing is in the UK, like I agree, it's the rate hikes have taken a while to take effect, and I think that's for a number of reasons. Like first, as we talked about, the lag because of mortgages. Secondly, inflation has been much higher due to a lot of Brexit related changes on the border kind of coming in just when inflation was at its worst, and so kind of exacerbating that and kind of slowing the return of inflation back down to where we've seen in the US and in Europe. And also the UK just did a lot more fiscal stimulus during COVID than, certainly compared to the rest of Europe. They printed more and they gave more checks to people. And the last thing I was going to say is that they have a much bigger labour market issue than the rest of Europe because, again, Brexit related, and people went home over COVID, and there's a lack of labour. There's a lack of labour in the UK, and so the pressure on people through getting fired or through not getting pay rises is much less than it is in Europe. And so you've got this, you just got like all of these different factors adding together, but ultimately, in a couple of years, does that mean that, the long run rate of inflation will be higher in the UK? Probably not. These Brexit related food issues can be fixed. It's a bunch of red tape. People need to work out how to get through it. If the price of food is higher in Europe than it is in the UK, someone will make money out of that and will slowly bring the price down. That labour shortage will fix itself one way or another, either through more immigration or through a recession caused by the impact of these rate hikes. And so ultimately, for the market, I think the market is wrong in thinking that the long run rate of UK inflation is going to be higher than elsewhere. I think it's just, the temporary spike in inflation is higher, and that's what makes it a good receive compared to everywhere else.
Yeah, no, I agree. I would note that the Brexit thing gets exaggerated, and I even kind of walked into it a little bit on Twitter. And everyone was quick to say, check the immigration is running high. That's kind of why it's a political issue.
But not high enough.
600,000.
Not high enough.
Maybe not high enough.
And I think the thing is, I think there's a lot of EU migrants, workers who were not really being properly recorded. And so I think, in fact, if you look at the past data suggests a lower rate of migration to the UK than was probably actually true. And so, we see high migration now because everyone who comes in, has to be accounted for, whereas before that wasn't the case. And so I think actually those numbers sort of tell a bit of a lie.
Yeah. I was talking last week's guest, Professor Steve Hanke, a wonderful gentleman. He has Steve's rule of 95. 95% of what you read in the financial press is just complete nonsense. And I was choking on my breakfast today. I think I kind of copied and pasted two quotes. One, which was just a sad reflection of central bank, the role of central banks today, and the lapdogs of the guys and girls managing these funds. There was a comment from the CIO of one big asset management group, which has $1.2 trillion of assets. And it's like, the Bank of England, the problem is they've got a checkered history in sending comforting signals to investors. It's like, where is money in that sentence, right? They have a checkered history in sending comforting signals. That guy is responsible for $1,300 billion, and he is responsible for absolute tripe. And then you had, and I have to say, I don't want to get into a fight with him, but Errayan, what's he called? The Egyptian, the former PIMCO economist. Hendry, yeah. I really don't know his role in the financial universe, except to be dull and to give gravitas to the boards of institutions that are like seeking to. Yeah, I don't know. I don't
I
get him,
think
but
if you want to know what
again,
the consensus is, read what he says. You'll probably he's probably a
he's a
quick
good
route to
sport.
that.
So the current, according to Hendry or whatever, the current phase of high UK inflation is similar to the 1970s. Well, no, it ain't. Again, I don't know if you've seen me mention my pin-up, my wonderful North Star just now, Sylvania Tenrero, who just stepped down from the MPC rate setting committee. And I've given reference previously to her valedictum speech, having stepped down. She's got amazing charts. The energy shock to the UK over the Ukrainian conflict was greater in magnitude to the oil shocks of the 1970s. And yet the inflation peak, even the grotesque peak, is running at 50% of its peak levels in the 70s. So it is patently not enduring something similar to the 1970s. But anyway, Tom, so this is going to be very...
I was just going to say, I had a comment on the energy thing. So obviously that's mainly due to gas prices, and if you look at where storage levels are right now, it's significantly ahead of like 5-year average for European storage. And so the fact is, like, there isn't, the tanks are going to be full. It's just a question: are they going to be full the start of September, or are they going to be full the end of October? Like, they're going to be full for winter. So there's not much more that can be done in terms of gas. And so I don't know, like, my kind of view on that is, there's always the prospect of some kind of a ceasefire in Ukraine. Obviously that would have a significant negative impact on the price of energy. And yeah, so I think the energy situation in the UK and in Europe is looking a lot better than people expected. If we'd have had this conversation a year ago, and we would have tried to guess what the price of European gas would be right now, we would have not come anywhere close. And so it's been a good news story.
You'd be too high. But again, with regard to the exceptionalism of British inflation, nowhere do you read that the most exposed European sovereign nation to having nat gas as the principal feedstock was the UK. Okay, I mean, so the UK would have a higher impact, and it has had a higher impact. Secondly, the UK and other countries had to subsidise the surge, and that was arguably a good thing. But having eaten it on the price surge, they'd been very slow to then bring the tariffs back down to follow where nat gas. And I want to say to you, it's only as recently as about no more than 10 days ago that the actual household sector is beginning to receive lower tariffs. It's quarterly contractual or something, or 6 monthly. So again, the British exceptionalism, the energy prices are now being passed through. The household sector is about to be, brick's about to hit it in the head. But back to Tenrerio, I mean, she was saying, hey, listen, the charge sheet against us, the Elgarenian charge sheet is they were too slow. And he said, and she was saying, we can patently reject that. We can model that. You have, you can simulate for the MPC being at 5% in March of last year, not today. Today they would be at 7%. And they would be at 5 March of last year because with perfect hindsight, you'd have seen Ukraine. You would know the acute sensitivity of natural gas. You would know that natural gas prices were going to surge. You would have known 6 months before that there had been a vaccine that would have kind of pulled us out of the horrors of the pandemic slowdown. And so you'd be at 5. And like I say, and you would have raised steadily to 7 presently. And she said, and you model that, and it takes for sure, it impacts on headline CPI, but it basically brings it in by 2 percentage points rather than flaring to what, 10.8 or so. It's more like 8.8. The only difference is now your central economic expectation would be for a contraction in British GDP of between 3 and 5%. So I still don't fully buy that they were too slow. I buy that these were events beyond the control of monetary policy.
Right. I think they were too slow in reversing QE. I think in terms of the money supply, it was, particularly when you look at the US, it was kind of ridiculous to carry on QE as long as they did. They knew the vaccine was out. They could see the economy was booming in early 2022. That was the time they could have, it could have been reversed a bit more. But yeah, I kind of agree with you. Why not wait and see what happens? I don't think really any damage was done by waiting. As you say, it's a couple of percentage points on inflation, and presumably GDP would have been lower, and may not have come back. And so, if you manage to avert an inflationary spiral, that's all you need to do. My personal belief is that, whilst the current kind of wave of inflation is coming down, longer term, there are factors out there which are going to lead to a respringing back up of inflation. And so that's a different point.
Yeah,
the supply shock that we saw out of Ukraine and the sort of turned out to be excess fiscal stimulus. That's a different point.
No, indeed. But that is the thrust. That's the second part of this conversation, and it really is the principal part of this conversation, because I have access to all the data, and I cannot for the life of me understand why the Fed does not see the absolute enormous and imminent danger of a pretty severe deflationary global recession. But you see that same data and you draw other conclusions. So, folks, I'm afraid the time is precious. We're getting to that point where it's VIP access only for the Patreons. I'm very sorry, but I would encourage you, if you are enticed by our conversation and you want to know how a professional hedge fund manager operating a fund today out of London, how he is reaching conclusions which are radically different from asset capitalism, then come on, folks, sign up.